Good afternoon, and thank you for joining us for today's webinar, Navigating Nexus, Unveiling the Complexities of State and Local Tax Compliance. I'm Becky Wyan, and I will be moderating today's presentation. Before we get started, there are just a few housekeeping items I'd like to cover. If you have any questions at all during the presentation, you may enter them into the chat box on your screen, and we will try to answer as many questions as we can at the conclusion of the presentation. However, to be respectful of your time, we know that we may not be able to get to them all, so therefore, following today's webinar, we will review all questions and send out an email with the answers afterwards, along with a copy of the presentation and a recording of today's webinar. You can also, there's also a copy of the presentation under the handout section, but as I mentioned, we'll be sending in one afterwards. All right, well, let's get started. Today's webinar will be given by Kathy LaMonica, a principal on our SALT team, and she will shed some light on the critical aspects of Nexus for both direct and indirect tax types and equip you with the knowledge to navigate those complex waters with confidence. Welcome, Kathy.
Thank you very much. Thank you for the introduction and welcome all. Thank you for taking time out of your lunch hour to listen to this. Hopefully you find it insightful and helpful. And as they mentioned, that any questions you have, throw them in the chat, and we will follow up with answers if we can't get to them all. But this is a very kind of complex topic, and I want to hopefully give you enough guidance to move forward with it. So with that, we'll get started. There we go. I just, to get a little background of me, I joined Ray & Associates about 6 years ago, and I focus in state and local tax group, primarily with sales and use tax for technology and consulting. And I've been doing this for 20-something years in various public accounting firms, industry. So I've seen the changes with Nexus and where the states have gone with their regulations in the past 20-something years, and I hopefully can give you some good guidance on that. So a little bit on the agenda. First, I'm going to go over some Nexus fundamentals. I mean, some of you might not even know what the definition of Nexus is. I'll tell you, I use this word 1,000 times a day, and to define it is one of those really difficult words to define. I finally got a definition that I can use, but I'll give you some background on what it is, what it means, and why it's important to your business activities. We'll talk about what the difference is between physical presence nexus and economic nexus. We'll navigate, how sales tax has changed since the Wayfair case in 2018 and what impact that has had on businesses and what it means for you guys. And we'll also talk a bit about expanding income tax nexus. The Wayfair case in 2018 was a sales tax case, but it has had implications to the income tax side of things from a state perspective, and where public law 86272, and don't worry, I'll define it later, will come into play and how that affects you as well. And then what do you do once you find you have Nexus in certain states? How do you determine it? How do you mitigate any risk you might have? And how do you go forward and try to comply the best as you can to make sure you're doing it right going forward? And then finally, we'll have questions and answers. So, okay, so Nexus, what is it? Nexus is the connection between a taxpayer and a state that is deemed sufficient to allow a jurisdiction to impose tax. That's probably the simplest definition I've been able to come up with, but it's basically saying once you have hit this Nexus trigger, once for whatever reason or whatever factor that's creating Nexus for you, it means that the state is allowed to impose their different regulations and rules on your business. Now, typically when we're talking about it, we're talking about sales tax, income tax, tax level Nexus requirements. But there are, once you hit Nexus, you may have other business registration requirements depending on what kind of business you're doing. If you have Nexus, there might be other responsibilities outside of tax. Typically, what we also see is Secretary of State requirements, registration and qualifying at a state level. We're going to talk mostly about the tax implications regarding Nexus, but there are other things that you should be aware of if you're talking about hitting Nexus in a given state. So I'm going to give you a quick background on the evolution of Nexus. Again, I mentioned I've been in this business for a while. So I know when it started, physical presence was the thing. It's a store, it's a plant, it's a warehouse, it's an office. You have employees in a given state. Those were the standards for physical presence was the standard for determining Nexus. You knew if you had a brick and mortar store in Nebraska, you had Nexus in Nebraska. You were making sales out of it. You were complying with the Nebraska rules. Physical presence has always been the factor. And anyone who's done business for a number of years knows once you're in a state, physically located in a state, you have Nexus. But we'll talk about how physical presence may be more than what you think it is. And then in 1992, so there was a case by the Supreme Court, the Quill Corporation versus North Dakota. Basically, 1992 said, in the Quill case said, there has to be sufficient activity to establish Nexus. Basically, the Quill Corporation was a mail order company that was making remote sales into the state. That was not enough to give that business Nexus. So Quill basically said it has to be physical presence. There has to be more sufficient activity to tie a company other than just sales to the state. So if you think back in 1992, internet really hadn't exploded yet. There wasn't a whole lot of e-commerce, online e-commerce. There was, mail order catalogs and whatnot. But at that point, that case said, nope, you still need something more sufficient to create Nexus. So if we look at what happened over the next 20 plus years, obviously business changed. The internet exploded. Businesses were now selling not just out of brick and mortar stores or mail order catalogs. They have the internet and they're selling through the internet. And over the course of the 20 years after that, there were many laws that came on the books and sales tax regulation laws that were known as kind of kill quill laws, because they were based on businesses who were brick and mortar, who were kind of being penalized because they had a location in the state. They had to charge tax, but businesses who were selling from outside the state didn't have to charge that. The states were recognizing that business was changing, and they were recognizing that they're losing revenue because all these states are selling into or delivering product to these states, but they're not collecting tax on any of them. And if you look at a furniture company who was sitting in Ohio selling furniture, they had to charge tax on their furniture, but someone could go to North Carolina, buy furniture without tax, bring it back to Ohio, and there was no implication. Now, I'm not going to get into the use tax side of things here. Technically, that person would have owed Ohio use tax on the furniture, but as a consumer, that was businesses and states knew that that's not where the revenue was going to come from a state side perspective. So they started adding these rules. The affiliate Nexus, basically having someone in a state who's doing something on your behalf, was good enough to create Nexus. Notice and reporting, which is you didn't have to collect the tax, but you had to out your customers that you were selling to in a state. Click-through Nexus was sort of the precursor to where the Wayfair case went with economic Nexus, but that was more like when Amazon said, okay, we're going to start collecting everywhere, but they weren't collecting for their third-party sellers. So click-through Nexus said, if you're selling through Amazon, you're a third-party seller through Amazon, and you have $10,000 of sales, $10,000 of sales with Amazon, you have click-through Nexus. So you should be collecting sales tax on all your sales. Basically, all these rules were set up to challenge the findings in Quill, saying business is different. Our e-commerce, the way we do business, the way we sell things, the way people buy things is different. The state laws needed to keep up with that and be able to, get the revenue that they felt they were entitled to. So all of these Quill laws were meant to eventually challenge the findings of Quill, and hoping that the Supreme Court would pick up a case that would challenge it and overturn the Quill decision. So the next point was, there we go. So in 2018, there was such a case, and I can't remember when that first started because it obviously didn't show up at the Supreme Court, until 2018. So the case was actually initiated earlier than that, but it was between Wayfair and South Dakota. South Dakota actually had a rule on the books that is very similar to what we see now with the economic nexus. It was basically they had 100,000. If you had 100,000 in sales, $100,000 in sales, or 200 transaction, you had nexus in the state, even without setting foot in the state. So that case finally went to the Supreme Court. The Supreme Court reviewed it. They overturned Quill. They said no physical nexus is required. Economic nexus is enough. If you have sufficient sales into the state, that sort of threshold of 100,000 or 200 transaction, that was enough to give you economic nexus and a reason and a compliance responsibility to collect tax in that state. I've never seen states react and change laws as fast as they did after this decision, but within 2 years, every state that imposes a state income tax had a rule on the books regarding economic nexus for sales tax purposes. I think 2 states were holdouts for a while. It was Missouri and Florida, but they eventually also put the rule on the books, and it was in place, and varying degrees, but mostly the same thresholds: $100,000 of gross sales or 200 transaction. And we'll talk about how that's evolved a little since then. But they basically said we're going to get everybody having to collect tax if they meet these thresholds. And while this economic and this evolution of Nexus was mostly all about sales tax, it has seeped into the income tax Nexus rules and how and those changes that are now on the rise, because states are saying, okay, we got everybody for sales tax, how can we get the income tax too? So when you're determining Nexus, and there's different rules for different tax types. So I'm going to kind of go through sort of the variations between income tax and sales tax nexus, or as you know, I'll explain indirect or direct taxes and how nexus is determined for those different tax types, because there are variations. For sales tax, which is your indirect tax, you have the economic wayfare nexus rules, the 2018 sales and transaction threshold. You have physical presence. You have people, offices, location, inventory, and estate. You have nexus. There's other types of nexus or other types of triggers. You use fulfillment by Amazon. You can have nexus just because they're storing inventory for you in a state. You have third-party activities. You have subcontractors, sales reps that are doing stuff for you. That's enough to give you nexus in those states. I always say for sales tax, basically, if you sneeze, you have nexus in that state. There's really no there's very limiting amounts of things that don't create sales tax nexus to you, but it doesn't always mean that you have exposure. So we'll talk about that too. And then for the income tax side, which is your direct tax, they also have economic type rules. They have factor presence types rules, which is a different way of saying economic, but it's usually based on certain apportionment factors. We'll talk about that. And then again, they'll have physical presence. What income tax has that sales tax does not have is the Public Law 86-272. Again, I'll define it a little bit. Offers some protection. So you might have nexus, but you might not owe anything because you have these protections based on what you're doing in the state. And then finally, there is franchise tax, gross receipts tax, B&O tax, CAT taxes. These are usually doing business taxes. These are, if you register for sales tax in Texas, you're going to have a franchise tax. If you are doing business in California, you're filing income tax, you also have a California franchise tax. A lot of franchise tax, gross receipt tax states may not have an income tax, and so they use these other alternative tax in order to generate income. And again, they have economic and factor presence type standards that you have to meet to be able to have to impose them, but sometimes it's just doing business. And sometimes that doing business definition isn't very clear. But like I said, if you're registered for payroll tax and sales tax, income tax, you're probably going to have the franchise tax or whatever gross receipts tax that's imposed in that state. Differently though, franchise tax, gross receipts tax don't have the public law protections. So those are only allowed on the direct tax side of things. And one thing I wanted to stress here, a lot of people say, oh, okay, well, I haven't hit economics, so I don't need to worry about it. My sales are only 50,000 in this state, so I don't have to think about it. But I'm driving trucks into the state. You know, I have 50,000 of sales in Indiana, but I'm delivering in my own trucks in the state of Indiana, and I have been for 10 years. You've had Nexus for physical presence. You just haven't hit that economic Nexus standard. So those don't exclude each other. Physical didn't go away with the economic Nexus. It just added to what can actually create Nexus for you. So you need to be aware of that. I'm going to talk about some common physical presence triggers for both sales and income tax, because I think there's things that people kind of don't think about when they're thinking about physical presence. So we talked about employees being a common trigger, having a remote employee in another state. What they do may dictate whether you have Nexus or not. So again, with COVID, a lot of companies had employees. I'm going to move to Colorado. I'm going to do my job from Colorado. Well, that company now has Nexus in Colorado. You're paying payroll taxes in Colorado. You likely have Nexus for income tax and sales tax. Again, whether you have risk or not is something that has to be determined, but you definitely would have Nexus. There are some states that said, okay, well, if your employee is just like a back office operational person and they're not actually contributing to growing the sales or significant activities in the state, they may not give you Nexus alone. But it's one of those things you have to consider. And then the people that work for you, if they're not employees per se, if they're an independent contractor, a 1099, somebody who's acting as a subcontractor for you in those states, that is also giving you Nexus for sales tax and income tax. So they don't have to be part of your company. That doesn't save you if they're acting on your behalf. If you're performing services in other states, any kind of repair, on-site installation, commissioning of equipment, even if it's 1 to 2 days and they're out again, that could be enough to give you Nexus, and you're doing services in the state, so you're not going to have any protections from 86272. And again, it's employees, or it could be unrelated third-party affiliates, or not affiliates, independent agents or other companies. Delivery in your own trucks. So if you're delivering not through UPS or a third-party common carrier, if you have your own trucks or you have a related company who does your logistics for you, but they're like a sister entity to you, they're going to contribute Nexus to you. So by those activities, and subsequently those trucks, the delivery company is creating Nexus for themselves if they're in their own operating entity. And there's different apportionment for trucking companies based on mileage in a state, and there's different things that have to come into play. Warehouse or stored inventory. Again, I mentioned a warehouse. If you own a warehouse and you're storing in inventory, that's kind of obvious. But if you're using a fulfillment agency such as Amazon or other fulfillment companies, as long as you still own the inventory, meaning you're not selling the inventory to Amazon and they're reselling it, that's a different situation. If they're maintaining your inventory, you give them the inventory, they move it around and they ship it for you and fulfill the orders for you, then they are creating Nexus for you wherever they move that inventory. One of the challenging things about that is Amazon, can move it anywhere. You have no idea. And you may not even know in a year where your stuff is. You can generate reports and we can see where the inventory is at the end of the year, but it could be everywhere. And there was only one state who's kind of retracted from that. Pennsylvania rolled that back and said, if all you have with Pennsylvania is that Amazon is storing inventory, potentially storing inventory for you in Pennsylvania, and you have no other sales or no other Nexus, that's not enough to give you Nexus. But there are a lot of states that still believe, California being one, if you have inventory held by Amazon that's moved to California at any point, it will give you Nexus, not just for sales tax, but for income tax as well. And then offices, again, if you have a physical location with multiple employees, that's an office, you're going to have Nexus. But sometimes there's if you just have a remote employee, again, it goes back to what that remote employee is doing. But if they just have a home office, that might not be enough to give you Nexus. However, it may be give you enough for property tax implications, depending on where that employee is. You might have to file different reports for that. So those are some of the common physical presence triggers. people don't always think, if they think, oh, I've got a bunch of 1099 or subcontractors that are doing this work, that it doesn't indicate Nexus for them, but it actually will indicate Nexus for them. So keep that in mind. This is a little chart that I found when we're talking about the differences in sales tax and trying to determine Nexus. This was from Bloomberg, but it's kind of a quick little analysis of, figuring out whether I have sales tax Nexus. So does my company have physical presence in the state? Yes or no? If yes, got to register. If no, do you make remote sales into the state? Yes or no? No, you don't probably have to do it because you have no sales there. You still might have an employee, but if you have no sales there, you have limited risk. If your company's sales do exceed the Nexus threshold, you'd have to register. And I have over here, to calculate the risk exposure, because I'll tell you in a minute why, but states have adapted what their economic Nexus rules are. I often get questions, can you just give me a chart? Tell me where my, Nexus is. Or just give me a chart and I'll look it up and I'll see where my sales are. Well, now states look at either gross sales or taxable sales, but taxable sales doesn't necessarily mean what you think it does. So sometimes, they'll say, we'll include gross sales, or we'll start with sales. We'll exclude the sales for resale. We'll exclude those because they're commonly exempt. So we'll just ignore that, but we'll include the exempt services that you might sell. So you have to come up with your calculation based on the rules of the state. And if they look at certain factors and you're under the threshold because you don't meet that taxable sales, that's good. You won't have Nexus there, but you just have to make sure you're clarifying the calculation that's required for that particular state. There are a lot of states who don't want you to just register and file 0 returns, but there are states that will dictate Nexus based on your gross sales. So it includes everything, even if your sales are not taxable. So you have to look at those calculations. And then if you do exceed it, you'd have to register, collect, and file. If you don't exceed that, registration's not likely. There sometimes is benefits to registering anyway, and especially if a state has a reporting and notification requirement. I would never tell my clients to use this instead of just registering and filing a 0 returns. This is the notice and reporting is way more complicated to have to deal with, and you're better off just filing 0 returns and going forward. But there's often debates about what's the best course of action, and that's how we can kind of help you with that. Economic Nexus, as we stated, the rules that was generally 100,000 of gross sales into a state or 200 transactions. Since 2018, many states have dropped the transaction criteria. They didn't want to impose this rule on a business who makes, $10,000 in a state, but they sell like a widget that's, not a lot of money. So they were hitting the transaction threshold, but not having the revenue. And it just didn't make sense. They were going to get minimal amounts from this business. It's a hardship on the business to have to file. So they dropped the transactions to try to keep that a little bit more fair. There are a couple states, though, that still have sort of unique rules. New York, it's a $200,000, I think it's $500,000 is the threshold, and $100 or 100 transactions. So if you sell a big piece of equipment, for $500,000 and you've hit Nexus from the gross revenue, but you only sell one of them, you don't have to file because you haven't met the and. So some of those things are worth looking at. Again, there's sometimes benefits to registering anyway to start the statute, but there are different limitations and things that have to be analyzed. And as I mentioned, that many states have adapted what's gross, what's taxable, and how does that play into your calculation. One of the other questions that come up a lot, like I have a business who sells through their own website, but they also sell through Amazon. They also sell through Walmart. Does Walmart and Amazon have to collect taxes on your sales? I mean, that was the marketplace rules that came out after the economic Nexus rules that say anyone who's allowing other people to sell through their platform has to collect the tax for them. So Amazon will collect tax on any sale that goes through their platform. When it comes to figuring out whether you have Nexus or not, though, you have to think about, okay, do I include my sales that go through Amazon, even though I'm not going to pay the tax directly to the state on those sales, Amazon's paying. And some states will exclude marketplace sales. Some states want you to include those. Some states want you to report them, but say those amounts are being paid by Amazon to a state. And it will be interesting. And one of the things that I've been waiting to see is how an audit is handled in those situations. Because if Amazon collected the wrong tax, but it was for you, who's going to be on the hook for that? And that's one of the interesting trends I'm trying to keep on tabs of, because, you know, who's at fault if it's Amazon collecting for you. So those are interesting nuances to the economic nexus. Well, income nexus, if it's interesting to you, is it? Anyway, income tax nexus. So this is a little different. So income tax nexus, there is a slightly larger sort of post you have to hit to have income tax nexus. It's not as easy as a sneeze. There's more protections allowed for income tax nexus. Physical presence, again, is the standard. So if there's an office warehouse location, you have physical presence. But the protections of Public Law 86-272 come into play. Note that the PL 86-272 is only for companies that sell tangible property, so not service providers. So if you're talking to a law firm or a CPA firm and they're doing services all over the country, they don't get protections of Public Law 86-272. It's only for somebody who sells a tangible product. Factor presence is, again, the other standard that I mentioned that's similar to economic nexus, but it's a little different. It's usually they have to exceed these standards in their apportionment factors. So you have to have either 50,000 of property, 50,000 of payroll, 500,000 of sales. Now, so if you have one employee and they're making 60 grand and they're living in another state that has this factor presence rule, you could have nexus there for income tax. But again, some of the protections of PL 86-272 may still allow, so it may still apply. So you may not have to, you may file, but you may not be paying tax. So we'll talk about that. And then economic presence, as it's defined with income tax nexus, is generally more vague. So if you go on to the state regulations and you look at what this means for an income tax purpose rather than sales tax purpose, it's usually using the term doing business, significant business activity. What does that mean? And each state has regulations that are out there that will list 10 or 12 items like this is doing business, or these things don't constitute doing business. A lot of that is very much up to interpretation, and you really have to, you know, get an advisor who understands what the state typically sees these things as before you start making decisions of whether you hit those targets or not. But it's not as defined as of yet. It's not as defined as sales tax economic nexus. So what is Public Law 86-272? I've said this a bunch of times now. Public Law 86-272 is a federal law that protects out-of-state businesses from corporate income taxes, so direct taxes only, under circumstances where a business only is soliciting orders in a state. So basically what it's saying is you can have a sales rep who's going around to all these states and trying to drum up business for you, as long as his or her activities are just about soliciting orders in the state. You're not going to trigger nexus by having that employee, that sales rep, that 1099 rep doing these things on your behalf. It's going to limit that exposure from an income tax perspective. Again, I mentioned it only applies to businesses that sell property. So if you have service providers, if you have a repair company that's going into other states, none of those types of companies are allowed these protections, because it doesn't matter. You're physically doing something in a state or performing a service in a state, and that will, you know, it will, the 86-272 doesn't apply to that. You might still have to file an income tax return, but you can claim protection of 86-272, so there's no tax due. We have had certain, I've had different discussions with people about whether you even have to file. I know there's certain states that when you're filing an income tax return, you can check a box at the top or put on, you know, some sort of message on your return as you're filing that you're claiming protection of 86-272, and that allows you to file. You start the statute, but you have no exposure. Now, there might be minimum taxes that might still be due, but for the most part, it's allowing you to file, start the statute, and not have to pay any extra income tax. Franchise taxes, minimum tax still apply. So keep that in mind. I have had people who say, oh, you don't even have to file if you're claiming 86-272, but there is a benefit sometimes to filing and starting that statute, so they're not asking for questions later. So keep that in mind. But again, it's not service companies, it's not anybody who's traveling into the state to do business, installation, repairs, anything like that. That's not part of the protections. And just a simple example, sorry, I got a little fancy with the graphics. What does it protect? It's solicitation only. So it's isolated trade show visits. It's meeting with customers and potential customers and trying to drum up business. It's not if the sales rep is actually doing the negotiation of the contracts or signing, having the customer sign an order or handle orders, that's past solicitation. So you're no longer protected. Again, most of the states have sort of in their regulations, here's 10 or 12 things that you can do that are protected. Here's some that you can't do. And some are very vague, some are very strict, but you just have to read the rules and see where they're applying this and what makes sense. Trade shows, when you have people going to trade shows, but you're actually making sales on site, is going to probably exceed the protections, and it's going to give you Nexus. So you have to be aware of those things, but there are some states that'll say if it's less than 2 days in a yearly period, or I think California is less than 2 weeks in a year period, then it won't matter. So again, rely on your advisor to give you some advice if you're thinking of claiming 86-272. However, because income tax didn't want to be left out of all the changes with the Wayfair case, the Multi-State Tax Commission in, I think it was August 2021, came up with their own changes. They're basically saying, business is different. These protections shouldn't be as robust as they used to be. There are different ways of doing business that need to be applied and addressed and allowed by the states. So now some of the activities that defeat 86-272 is having a single employee teleworking, having a remote employee anywhere. It doesn't matter what they're doing or how they're doing it or where they're doing it. You have Nexus in that state for income tax. Placing cookies on residents' computers. So in the early days before the Wayfair case, there were sales tax rules that actually said, in fact, Ohio had one of them that said, if you have cookies on somebody's computer because they accessed your website and they downloaded the cookies or got the cookies on their computer, you had Nexus with the state. And that was for sales tax. The MTC changes are now saying that's enough for income tax. Providing post-order information via chat or email to a state's residents. And this one is interesting, and I've seen a lot about it. So you go to someone's website, they have a chat function. You bought a product from them, you're trying to figure out how to install it, and you go to that chat function and you start asking them questions. You already bought it, so it's past the solicitation piece. You already purchased the product. They're doing troubleshooting. They're doing it virtually through the chat function, but they're doing services for you, even though it's virtual. And the MTC changes are saying that's enough to give you Nexus. So they're definitely lessening the protections that 86-272 allowed. They're creating it or modifying it so that it works with the way we do business, but it's a very challenging change, especially when you think of with sales tax, any changes, if you've got to collect, you're collecting from your customer, you're paying it to the state. It's not your out of pocket if you're doing it right. Income tax hits you in your pocket. You have to pay out of pocket for income tax. It's not something you can pass through to your customers. California and New York both adopted the MTC changes, but apparently the way they did it had brought up some lawsuits, and I think there's still pending lawsuits. California apparently didn't do it right. I don't know what the implications or what they didn't do right, if how they tried to push through the changes. New York apparently did do it right, but there's still, I'm have to verify whether they're actually enacted and active now, but they were putting these changes through. And of course, California and New York are two of the most aggressive states anyway, so it makes sense that they're at the forefront of this, but it's something to keep in mind. I know a couple other states have since adopted. Minnesota recently adopted. I believe I just read that New Jersey adopted it as well. So, and I haven't heard about lawsuits in those states, so I would assume that they're actually still effective, and these rules are now the new way we should be filing. The one thing I would say about Minnesota is we have had a couple of e-commerce clients of ours who have been targeted by Minnesota. We did a VDA for sales tax a couple years ago for them, and they came back asking about income tax because of these new changes. And we argued with the state for a while because they're truly an e-commerce. They don't have anything physical. And what Minnesota was trying to tell them was, well, you have a chat function, so you can get customers can get information and installation assistance online through your chat function. So anyone in Minnesota who's buying a product, now you have services that you're doing for them. The other thing they tried to say was that the company, if they had sold to like a big box store, a Best Buy or something like that, if they had sold the product to them, but the customer bought it like on a rent to own kind of situation, Minnesota was trying to say you still own the inventory until your customer pays it off. And that one actually we won on because they were able to prove that they sold the product to the client, but the financing company was taking over, and that's the person who was, waiting for the payments, but our client was getting their amount. So there wasn't an issue with them still owning the inventory. But it's just an indication of how aggressive these states can be with these types of things. And as it turns out, I calculated what their risk would be if they had to file the last 3 years of income tax, and it was less than $200. And I said to the auditor, you're not getting what you think you're getting, so let's let this go. But it made me very wary for other clients that are doing business in Minnesota and what that could potentially mean. So factor presence was the other income tax aspect that I wanted to mention. They had, it's thresholds based on apportionment factors, and not every state has it. Only the ones in blue here: New York, Pennsylvania, Ohio, and Ohio's the cat tax, to Michigan, California, Texas. So that's still evolving. And then franchise taxes, gross receipts, B&O. Often found, these are found in states that don't have an income tax. Some are in conjunction, like California has both income tax, franchise tax. They don't have the protections from 86-272. If you're registered for a tax type, the sales tax, or you're filing income tax, you're likely going to have a franchise tax if there is one. Sometimes these are combined with Secretary of State filings, or it can be a separate additional tax. And you see some states that are phasing out or raising the threshold. I think Texas franchise used to be, just doing business, and I think it's up to 500,000 that you have to have in sales before it's imposed now. So they're trying to be, same with the commercial activity tax in Ohio, they're phasing it out. So it's a little less cumbersome for some clients. Washington B&O, which is this business and occupation tax, that's a little different. It's basically, they don't have an income tax, but they tax everything. So if you're selling 100% to manufacturers or distributors in Washington, they're still going to tax you on your wholesales, on your sale for a resale. It's a small rate, but they're still going to make, and same with services. It's just a different tax calculation. So when you figure out that you have Nexus, when did Nexus start in a state is the next question you need to ask yourself. Again, physical presence goes back, before the dinosaurs. If you've been If the business started 20 years ago and you've been driving trucks into the surrounding states for 20 years, you had Nexus in those states for 20 years. That doesn't go away. Your economic Nexus, though, started in 2018. If the business didn't hit 100,000 in sales in Indiana until 2022, but they've been driving trucks into the state since 1965, they had Nexus since 1965. They don't off, they don't erase each other. So you have to look at both sides of it to figure out when your Nexus actually started. And what we see a lot with is clients who probably had large sales and gross sales of high dollar amounts in states. So as soon as these economic Nexus rules went into place, they had Nexus day one. And even though states gave you a half an hour, they gave you 30 days, 90 days to get compliant. Some states were like your very first sale after you hit that threshold, you have Nexus, you have compliance, you should be registered. So there is varying degrees of how these get waved in, but we have large clients who had 100 million of sales. They hit Nexus in every state when these rules went into place. So it's something to be aware of, because the when will really matter how you go forward. And then part of this too is if you're selling, your Nexus, if you're selling primarily to manufacturers or wholesalers, you might not have a lot of exposure. So you might have met Nexus, but you didn't have a lot of sales tax exposure, and you might not meet income tax Nexus if you're still protected by 86-272. But the questions become, if you've been doing services in other states, it's really looking past the economic numbers sometimes and trying to figure out when you actually hit Nexus in a given state. So I typically get a lot of commentary as I'm giving these. We meet with clients for the first time, we do a Nexus study, Nexus review, and I get a lot of comments about, why do we need to do this? Or why does it even matter? Or, and the old days, people would be like, okay, thanks for the information. We don't need to do anything. Commonly, I'm going to put up some questions or comments that I typically get and address why it matters. So let them catch me. We heard that a lot. Let the states come get me. And I will say they will eventually get you. Someone will probably get you. It's more common now than it was 10 years ago, but it's a lot easier for states to find you. Typically what we see is our client gets audited, or our client's customer gets audited. The auditor looks at who sold you this and didn't charge you sales tax, and then they come back to our client who now is on the hook. I had a client recently who we established that they had Nexus in about 5 states and they didn't want to do anything. This went on for about 4 years. And every year we'd update the exposure to figure out what they actually owed. And then finally, Michigan called them out of the blue and said, hey, we think you have Nexus. Now, we don't know how they found out, but the assumption is one of their customers probably got audited. So at that point, it's difficult to do something to remediate. So technology advances, while slower at the state level, agencies have become to be really easy for them to find people who are selling things. I had a small furniture dealer in Ohio who got a Nexus notification from California. They had maybe 2 sales there. So they didn't have Nexus there, but they were found anyway. So they will catch you. It may not happen, but the likelihood has increased a lot. I'm going to sell my business in a couple years anyway. This is the perfect time to find out if you have any exposure. I've been a part of 3 or 4 due diligence this year. From the buy side, comes in, finds these state tax issues, said, let's get them cleaned up. And what can happen is so a buying company is not going to buy a seller company if they have an extraordinarily amount of sales tax issues without either lowering their purchase price, putting in an amount in escrow, or making them take care of it. And we've had to clean up a few companies that had not done the right thing. And so we wanted to make sure that, if you're thinking you might have issues, get ahead of it now so it doesn't come up when you're doing due diligence. We will just register and go forward. that might be good in concept, get compliant, except if you have a lot of exposure in the back. And I will say that once you register with a state, commonly, most states, once they know who you are not going to give you the benefit of a voluntary disclosure. They're not going to give you a cut on audits or, cut on penalties. Once you register and go forward, you lose a lot of control over what you can do to remediate or fix any kind of past exposure or damage. The other one was, we'll just tell our customers to pay the use tax themselves. Also not allowed. If you have Nexus, you can't tell your customers, you can't shift that onus to them. If you have Nexus in a state, it's up to you to collect it. You cannot shift the burden to them. Now, an audit, if they've been self-assessing use tax, it may help you on audit. If you didn't collect it and they paid it, that could help you, but you can't use that as a business practice to go forward. And then we'll just charge one rate to everyone. I have had a couple clients who've said, yeah, I'm just going to charge Ohio no matter where I'm selling it to. And I was like, you can't do that because one, California, who should be getting their piece of the pie, is not getting their money, so they're going to be unhappy. Your customer thinks you're charging them California tax. You're not. You're charging Ohio, so they could be on the hook for exposure. And you could have a class action lawsuit against you if you're charging either too much or too little and customers are not getting the right rate charged. There's 15,000 jurisdictions in the country. It's hard to track that manually, but you can't just say, I'm just going to charge one rate for everyone. So it is complicated. It's hard to deal with sometimes because there could be a lot of exposure and a lot of compliance that has to happen. But we're here to help you and make it better and get you in the right place so that, there's no outstanding liabilities that could hurt you in the future. In essence of time, I'm going to skip a couple of these things, but one thing I wanted to talk about was, skipping over this one. So we were part of a due diligence company, and I just wanted to give you a little taste of what something looked like. This was a new client to Ray. They were not somebody who we had been doing business with prior to this, and their buy side, they sold widgets. Their buy side advisors determined that they had Nexus and liabilities in 15 states. And it wasn't huge amounts. I mean, I've seen bigger in some due diligence, but it was pretty big. And the seller had no idea. She said, she had assumed that all the sales were exempt. They had exemption certificates on file for some customers, but they just assumed, we're selling to manufacturers or distributors, we're good. And that wasn't the case. So as the buy side had done their due diligence, we subsequently went through and looked at where the customers were and who was taxable and who wasn't. And we, reaffirmed and calculated and estimated new liabilities. And they had customers that were taxable just because they were using the widget themselves and not putting it as a raw material in production. So they had to come up with the tax that they should have collected from these customers. So what we did is voluntary disclosures, which are basically you go to the state, you say, we owe this much amount of money. We pay the tax, we give them the details. They waive penalties. They'll limit a look back to 3 to 4 years, depending on the state. I think Nevada goes back 8 years, so sometimes that's not beneficial. And they pay the tax and they get compliant. And the states agree not to audit, not to look back. The only time I've seen that ever challenged is if the state thinks, you either lied on the VDA or you're trying to be fraudulent, and then they might audit anyway. But for the most part, they typically sign the agreement, you pay your tax, you get compliant, you go forward, and it's done. This client, we had to do VDAs in 15 states. They paid about $150,000 in sales tax to the states. They had to pay some franchise tax in California and Texas as well, because those came up as they were just going to be imposed, because even though it was in a sales tax issue, those taxes were applied as well. So, it bummed the seller out a little bit because she had no idea that she had this exposure in her back pocket and she didn't like dealing with it, but it got clean, and the company going forward who bought it knew that they didn't have any skeletons in the closet they'd have to worry about, you know, years from now. So do's and don'ts. Work with a professional, work with us, help us analyze your Nexus footprint and establish if there's any risk. Plan ahead if you're going to change businesses and or business models, if you're going to start selling through a platform, or you're thinking of selling your business, or you want to do a new product, you're going to switch from B2B and go B to, you know, business to consumer, because we can help put stuff in place so that you're not building exposure for later. Get a professional involved if you get a Nexus questionnaire from a state, if you have, again, an audit initiation, or just even questions about a prospective audit. Let us review and let us understand what can be done before that. Take advantage of the tax technology tools that exist to streamline the process. There's a lot of things out there. We can help you get them, streamline your processes so it's not as overwhelming as it will seem. A couple don'ts: don't go it alone. Again, just stressing, get your advisor involved, get information about, you know, how we can help. Don't register without knowing if you have past exposure, because it will raise flags. If you suddenly file a return and you had, you know, no sales yesterday and this month you have $10,000 in sales, they might say, okay, did you have Nexus before? We've had states go back and say and reestablish that Nexus really started, you know, a year before from when they registered. Don't neglect the importance of exemption certificates. If you're selling to resellers, if you're selling to manufacturers, agricultural, any exempt organization, those might seem like just a piece of paper, but they're essential to protecting you from tax exposure on you. And don't collect sales tax before you're properly registered in a state. That's, at the very least, it's wrong. In some states, it's actually a felony. So you don't ever want to collect tax all of a sudden for states if you're not registered and can't remit it. Sales tax is a trust tax. So if you're collecting that money from your customer, it's not your money. It goes to the state. If you hold on to it, it's frowned upon. So you definitely don't want to do that. If you do have a situation like that, it's best to figure out how do we address it and get it paid or get it credited back to your customer. And how can we help? And determining Nexus footprint, you know, where you are for what tax, where you have compliance responsibilities, calculate whatever risk you might have from the income tax, sales tax, gross receipts tax perspective. Part of calculating that risk, we'll look at what you're selling. Is it taxable? Is it exempt by statute? Is it exempt based on who you're selling to? We will recommend and implement a realistic strategy to move forward. I might tell you have Nexus in 37 states, but it's not feasible for you to register and get compliant in all 37. We'll look at the aggressive states. We'll look at where should a voluntary disclosure be done. We'll look at where you can register and go forward, where you're not going to raise a flag. Or we'll look at where there's states, maybe we don't do nothing, do anything right now. We might wait, you know, phase it in, do it by, so that it's not overwhelming. Wait until we have software involved so that we can help do it easily without hurting your company. Integration of technology to assist. I have a team who does sales tax software implementations, taxability reviews, and product mapping, all that stuff. We can help you soup to nuts on all that. Exemption certificate management, building processes, and whatnot. And then ongoing compliance for all tax types. Obviously, if some of you are clients already, we're probably already doing your Fed tax, could be doing your state taxes too. There might be more states we should be filing. We can look at that and make sure it's being handled appropriately. And we have a very robust sales tax compliance team who can do all your sales tax compliance as well, and take that burden off your plate. If you have questions, any questions, and that's it. I'm seeing we're running out of time, so any questions? Yeah. Okay.
Thanks, Kathy. That was a lot of great information. We do have some.
Okay.
So first question, since every state is different with the Nexus rules, is a chat available for how Nexus is defined by state?
There are different charts that are available, but what I would go back to is how those states define, you know, taxable versus gross sales. It will vary. You know, it's best to, you can Google for a chart and it'll give you a high level guideline, but it's best to have someone else to kind of walk you through it as well.
Perfect. All right. I'll give everyone a second. If you guys have any other questions, you can go ahead and put them in right now. You know, and Kathy does have her email there. So if questions do pop up later on after reviewing or when we send out a follow-up email, do let us know. Okay. Okay, next question. Customer from PA comes to our Ohio store and purchases a large barbecue grill. Hold on one second, I scrolled too fast. They pay here, but ask us to deliver to their residence in PA. We charged Ohio sales tax since they were physically present in Ohio. Do I have Nexus due to delivery? Do I have exposure?
So if you delivered it in your own truck, you're going to have Nexus exposure. You collected the tax there, but if you're actually delivering it to there, the tax really is sourced to Pennsylvania. But if you don't have Nexus in Pennsylvania, like if you delivered it via UPS, you wouldn't necessarily have Nexus. So it will depend on what your sales amount in Pennsylvania are. If you've hit that threshold, you might have Nexus, and then you'd have to be collecting Pennsylvania tax, because typically with sales tax out of state, it's based on the destination by delivery, unless they picked it up on site in your Ohio location and brought it out themselves.
Yeah. All right. That's all the questions I have. So if there's any final thoughts before we sign off, Kathy?
Nope, just keep us involved. Even we can do high level Nexus reviews. Just if you're just trying to get a touch base footprint, we can do in-depth pre-due diligence types reviews, any level in between. And if there's any kind of sales tax question you have at all on any part of it, you know, or state tax in general, you know, let me and my team know, because we can definitely help.
Perfect. Thank you so much, Kathy. A lot of great information. And as I mentioned, we will be sending a copy of the presentation along with the recording afterwards. So look for that. And thank you so much for joining us today. I hope everyone has a great rest of your day.
Thank you. Okay.